Hello, this is Troy Patton, and welcome to the call. This is the third quarter 2015 October update. We're giving you some information here on the markets, and as always, this is a follow-up not only to our September special update, but to our mid-year outlook and update. One of the things, again, my name is Troy Patton. I'm one of the portfolio managers and president of Archer Investment Corporation. And one of the things I'd like to tell everyone today is that often the times the market's already passed, we're looking forward. We're wanting to know what's going to happen in the market going forward, not necessarily always what's happened in the rearview mirror. Driving in the rearview mirror can cause accidents. Right now, in this time of year, we've seen a political circus erupt on the scene, and that's obviously creating a little bit of havoc with some of the sectors in the economy. Namely the healthcare and biotech drug stocks. As we always say to our kids, this too shall pass. So with that being said, let's go ahead and get into it and discuss a little bit about the markets. The first, obviously, is just a real brief slide here, and it really tells us kind of where we're at. Basically, the market, where we believe it is currently today, is really fairly valued. Anytime it's in between these two dotted lines is somewhere between that average, and at this point, we would say it's fairly valued. The one thing that we would make a comment on is that clearly there are some expectations that maybe the market is a bit undervalued, only to the idea that interest rates are so low, what we would call the earnings yield spread versus the bond spread. So from that standpoint, we would say that the market is somewhat undervalued at this point. But in all attempts, we would also say that the market is fairly valued. Okay. One of the things that we are concerned about here, and that we've been tracking for some time, is on this next slide, is the advanced decline line. As you can see, the advanced decline line has continued to go downward. What this means is that we take companies that have gone up and for a day or a week, and companies that have gone down for a day or a week, and we look at their volume. And if the volume of the ones that are down are much greater than the ones that are up, then obviously that creates a downward cycle. And we've been seeing this since the tops about May. So what I've done here is I put two blue arrows. And these blue arrows is really where we need to kind of get back to before, if we can break through those top points on those blue arrows, we will probably see the market rebound and start to move higher again. As most of you know, for 2015, we predicted approximately about a 6% return in the S&P 500, much more muted than we have in prior years. Not necessarily because we think things are bad, it's just that we believe that the growth going forward is going to be very, very muted. We really don't see a whole lot of growth. We've also seen some other, I'd say, special circumstances that we'll explain here in a second that have played into the market as well. This next slide, as many of you have seen this before, and it really is nothing more than to sit here and tell you that, look, we've played this game before. We've seen the market decline. As you can see, even back in 2011, the market really did take a big downturn. It was down quite a bit. And there were a lot of people at that point in time that said, oh my gosh, we've got to get back out of the market. The market's going to really fall apart. Had you done that, you'd have missed out on about a 50 to 80% return, depending on what you were invested in over the next 3 to 4 years. So it's really not a good time to get out of the market. If you have a good long-term plan, stay in the market and stay invested. If you've switched gears and now you're in a short-term plan and you say, hey, I got to take all my money out, I'm either going to spend it tomorrow or I'm going to bury it in my backyard, great. I understand. You probably ought to pull the money out. But for 99.9% of you out there, no matter what age you are in, it's still a long-term game plan. Okay? Just another thing that we track quite a bit is the earnings ratio. And as you can see, the color, the pumpkin color in the quarter to date versus really the blue column is this time is this quarter that we're in now. The pumpkin color is the prior year, the same quarter. And you can see the earnings are down Well, I shouldn't say they're actually not down. They're only down if they're below the 1 mark. They're actually above where they were last year, but on a very limited basis. They really have not accelerated as they have in the past. And we can kind of look at this, and we can even see the prior quarter, the same scenario exists. One of the main rationales for this, as we go to the next slide, is in the upper right-hand column. We can see that the U.S. dollar year-over-year percent change quarterly has gone up in the third quarter 2015 from the previous, 4 quarters ago, the same time, which is the smallest bar, right, 2 over from the 15. We've gone up 17.9%. Well, what does this mean to everyone? Well, one, it does mean lower oil prices and lower prices at the pump, which we've all been very fortunate to have. For those people who have traveled overseas, you definitely see how the U.S. dollar can buy more goods, whether it be in euros or any other currency, compared to the rest of the world. It's not necessarily that our sales have tapered off near as much as what a lot of people think. It's more that the U.S. dollar has actually increased over the last 4 quarters, and has created some of these hardships, or some of this what you would perceive as a slowdown in the U.S. economy. But in all effects, the slowdown really it's not declining. It has slowed down, but not what I would consider a recessionary type slowdown, where people are stopping purchasing items, they're not buying things, that sort of thing. A couple of the things here that have contributed, obviously, to the earnings being down, also in this bottom right-hand chart, is the energy sector earnings. Clearly, the energy sector has been struggling. Oil prices have fallen. Those companies are not making near the money, which really starts stopping a lot of different capital processes and purchases, and in effect can sometimes escalate into other sectors to where earnings fall as well. But we've obviously seen this with the energy sector currently. Well, many of you might be saying, well, gee whiz, Troy, I mean, with the dollar way up, oil, the oil sector or that sector having problems, why should we expect the market to continue to climb? Well, the next page, there are 4 slides here. And I think the most important slide are really the 2 on the left, okay? The corporate cash as a percent of current assets. As you can see, from the year 2000 till today, we've doubled the amount of cash as a percent of current assets on the books of all corporate balance sheets. It's like at home. If we had $10,000 in savings, now we would have $25,000 in savings. Okay. So the corporations have done very well. They've hoarded a lot of cash. They have not gone out and incurred a lot of debt. In fact, the bottom chart, the cash return to shareholders, they've actually continued to increase their dividends to the shareholders, as well as buying back stock. In fact, the number of shares that have been out on the open market have actually continued to decline. So it's a simple supply and demand. That in and of itself, I think, should fuel the market somewhat higher, somewhere to the tune of 4 to 6%. That's why, actually, this year we estimated the markets to be up about 6%. Not necessarily because we thought earnings were going to rise, but we really believe that, one, there's less shares out there. If you own General Electric, and this is just for example, and there were 1 million shares outstanding, and they made $1 million this year, but next year there were 900,000 shares out there, but they still made that same $1 million. Those 900,000 shareholders that are out there, they actually made more money, even though the company in and of itself didn't make more money. See, we think that will actually propel this stock market a bit higher, and we think it will over the next several years as well. Yes, there are concerns overseas of different countries. We're seeing a lot of unrest in the Middle East right now. That obviously could have a very large impact with Russia getting involved in Syria, the plight of many, unfortunately, refugees into Europe. That could cause some hardships for Europe as well. But we really believe that the United States and the solid companies over in Europe, the ones that pay dividends and have good balance sheets, will continue to do well in the near term and in the future. The next chart, which is a really good chart from JP Morgan, really kind of shows how the market's progressed over time. As you can see, there are periods of time where we do sit still, and we saw that in the 2000s, and maybe we're still there. However, it looks to me like we've started to break through, and we're ready for this next technological advance coming to the United States, and I'll explain a little bit about that later. But we really think the markets are going to propel higher, not only because of, frankly, inflation. In my opinion, through the 2000s, the inflation wasn't running quite as high. But ever since they started printing a lot of currency, we've actually seen inflation increase. As I always joke around, those of you who don't know what I'm talking, don't eat or use energy in your homes. For the rest of us, there's definitely inflation. So we think the market's ready to take this next leg higher. One of the reasons we also think that the United States economy is going to continue to do well, as you can see in the past, there's actually been a growth in the working age population over time in the 50s, 60s, 70s, 80s, 90s, etc. But as you can see, that's actually been on the decline. And it's really just simply that most folks, think about this for a second. If we look back, even to my parents who were born in the 40s, and a lot of folks had children when they were in their 20s. Now, in my estimation, people are waiting longer to have kids, or a majority of the people are waiting longer to have kids, or even get married for that, from that standpoint. If multiple generations do that, we actually will skip a generation of a workforce. And so from the reason I think this chart is actually pretty important is maybe for the next 10 years, we only see about a 0.4% growth in the working age population. What does that do? It puts a high demand for jobs. People or companies wanting to hire people that aren't there. It actually increases wage pressure. And once again starts to increase a bit of the inflation. And that inflation will find its way into the market. It doesn't mean that Pepsi sells more cans of pop. It means that they'll just charge more for those cans of pop so they can continue to hire those good workers out in the workforce. And we've started to see a little bit of wage pressure recently, but not enough. And I think that will continue to escalate. The other thing is, if we take a look at these next charts, again, through FactSet, JP Morgan, the consumer balance sheet has obviously done much, much better. Household debt service has dropped dramatically. Household net worth has continued to climb. The people out there, I understand right now unemployment is supposedly somewhere between 5 and 5.5%. I really do think there's a lot of jobs available out there right now. I get it, the participation rate, although it's declined recently, it was very high. I do think that there are a lot more jobs out there currently than there were. And I think just the household is just much better off today than it was 10 years ago. Okay. I saw this the other day. I thought this was really good. You're nice, Melvin, but before I marry you, I need to see how you perform in a down market. That's exactly the case, right? We want to be prepared for the bull markets, but we also need to be prepared for the bear markets, and we have to perform in those bear markets too. So we need to, again, it's capital preservation, and it's a return on our capital, not necessarily. We obviously want a return of the capital, but we want a return on our capital also. But we need to make sure that that capital is preserved. So that's one of the things that we try to do at Archer Investment Corporation. We do feel like we are a bit more conservative than others, but at the same time, we believe slow and steady wins that race. And that's why the majority of our clients kind of fit into that moderate type category. Just another chart here talking about, should you cash out during a crisis? Again, this is the same chart that we had last time. Obviously, the answer is no. If you look 3 years later from 2005, 9/30/2005, 9/30/2002, 12/31/2014, if you just stayed in stocks, you really would have been in really good shape. In fact, your money would have doubled, if not possibly tripled from that point. Okay. The same thing, the value of patience during crisis events. The different things here, the Gulf War, the Asian market crisis, if you remember that. Some of that was the Asian contagion, the Russian crisis, September 11th attacks. 6 months later, in every instance, we were higher. The markets were higher. I think this time is no different. Obviously, 2008, 2009 are on people's minds. I don't believe that we're going to see that kind of downturn. I don't think we have that kind of bubble out there. If anything, there's a bubble in debt, but in all reality, there's certain countries like the United States and Japan and even Germany that I really feel like they can print their way out of these debt crises that may or may not exist. Okay. The other thing is, beware of the headlines. The market drops 3%. The market's up 3%. Okay. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So had you gotten out of the market, you would have missed out on some of those best days in the market. And really, that's all this is showing. It's the returns of the S&P 500. It's the performance of a $10,000 investment between January 3rd, 1995 and December 31, 2014. And as you can see, if you missed, different days, if you just stayed fully invested, it'd be worth $65,000. Okay. If you missed 10 of the best days, it really drops significantly. 10 days out of 10 years, and it drops significantly, and so on and so on and so on. So stay invested. There really is no crystal ball. Okay. This brings me to my next conjecture, and I'm going to kind of put this out there. If you're looking at this slide, I don't know if you know what this is or not. Some of you may, and some of you may not. It's a time machine. That's right. And right now they're building one, and we thought it would be a long time coming before we would see this. And I don't mean a traditional time machine, but I mean a hypothetical time machine in terms of a driverless car. Okay, I really believe the driverless car is going to change not only the ingenuity of America, but it's going to change. It's going to be the next revolution in technology that's really going to propel the United States forward. Basically, by some estimates, we've lost 400 billion hours of time driving cars. There obviously is a love affair with cars here in the United States. So a driverless car may or may not appeal to everyone, but at some point, the efficiencies that one can gain from being in a driverless car and not spending the time behind the wheel, but maybe reading, relaxing, who knows, doing more work, making phone calls in a safe manner. I really think the driverless car is coming a lot quicker than what I even expected. I remember looking into this last year and discussing it briefly, talking about how the automotive industry is spending more than any other industry in terms of technology. But I really think these driverless cars are probably 3 to 5 years in the making, and that's a lot sooner than what I predicted 1 year ago. But the technology that's coming on board is just fascinating, with companies like Apple and Google. Toyota just announced $1 billion in new money going towards driverless cars. I really think that those countries that embrace this technology are really going to be in the forefront of the next innovations, just like the internet was 10 years ago today. So with that being said, again, just some common misconceptions that we covered last time. But the market's too volatile. I'm going to sit on the sidelines for a bit so I don't lose money. Don't wait to invest in volatile times. It can cause you to miss out on potential market rallies. And make sure you have specific goals. Keep them in focus. Make sure you're looking at the long term, not the short term. It's, if we could get people to open their statements once every 3 years or once every 5 years, I think everybody would just look at it and go, oh, wow, that turned out really good. And if you pulled a Rip Van Winkle and woke up 5 years later, you'd be in good shape. Okay. All right. With that being said, again, we still think we're on target for our 6% return in the market through 2015. I know we only have a little less than 3 months to go, and that seems somewhat maybe out of reach to some, but I really believe that I think we'll see a positive return in this market to the tune of about 6%. I think the market will probably rally into the year end, especially as we see some year-over-year numbers come in a bit better based on the dollar increasing 4 quarters ago. So our year-over-year numbers won't look quite as rough as they did in this quarter. and I think that could propel the markets a bit higher. All right. Well, with that being said, I appreciate you being on the call and listening and taking a look at the slides. And if you ever have any questions, obviously consult your advisor or give us a call, and we're more than happy to answer any questions that you may have. With that being said, thank you very much, and have a good quarter of investing.